Good morning. It's nice to see so many familiar faces. My name is Stuart MacDonald. I am the CFO at Rockhopper Exploration. I'm conscious we only have about 10 minutes today, so I will run through these fairly quickly. But if there are any questions, please feel free to look out for me over at Stand 8. So briefly today, I plan to introduce the company for those that aren't familiar with us, describe our strategy, provide a summary of our operations and financial position, and conclude with our vision for the next 12 to 18 months. In terms of our strategy, we're looking to build a well-funded, full-cycle exploration-led E&P company, which we believe is the best route to value creation through the cycle. So where are we today? We're focused in the Falkland Islands and the Greater Mediterranean. In the Falklands, we have a material stake in a world-class, discovered and fully appraised oil field called Sea Lion. And in the Greater Med, we have a production and cash flow base which we are seeking to grow either organically through exploration or inorganically through acquisition. We're actively managing our costs, both at the G&A and at the operating level, and we have a strong balance sheet with cash of $45 million and no debt. Turning now to the Falklands, which is very much the genesis of the company and where the vast majority of our value sits today. In the Falklands, our focus is very much on the North Falkland Basin and the development of Sea Lion. In terms of the history, Rockhopper discovered Sea Lion back in 2010, and we, through 2010 and 11, drilled 10 wells to explore and appraise Sea Lion and the adjacent discoveries. In 2012, we farmed out a 60% interest across our acreage position in the North Falkland Basin to Premier Oil, a FTSE 250 oil company, in exchange for about $1 billion of undiscounted consideration, combination of upfront cash and development carries. The field has been independently assessed to contain around 520 million barrels of recoverable oil on a 2C basis, which is very significant by global standards, and which we plan to commercialize through a number of phases. The first phase of development will target around 220 million barrels in the northern part of the field. The development concept is a traditional FPSO development, which is increasingly standard across the industry. Premier themselves already operate or own 9 FPSO developments around the world, and actually the Sea Lion project has a number of very similar characteristics to Premier's recently operated Catcher development, which has been hugely successful. In terms of the North Falkland Basin, we're in about 350 to 400 metre water depth. We have benign metocean conditions, very similar to the central North Sea. And so from an engineering perspective, there really is nothing unusual about this project. If anything, people worry about the remote location, but actually, we've already been involved and operated 3 separate drilling campaigns in the Falklands. The logistics are perfectly manageable. This slide here just gives a sense for the scale of Sea Lion and the North Falkland Basin and its potential through, as I say, multiple phases of development. Sea Lion can deliver very significant production, peaking at potentially 140,000 barrels a day gross over a 20-plus year life of field. As I said before, the Sea Lion project is significantly advanced. On the contracting side, we have entered into letters of intent with all of the key contractors for the project, and those detailed LOIs cover both the provision of services and the terms of those services, but also vendor financing, which forms a core component of the financing plan for Sea Lion. The FEED work, which is the front-end engineering and design, is substantially complete, and through the FEED process, we've been able to secure significant cost savings for the project. Project economics are robust, with life of field costs in the mid-30s per barrel and a break-even in the low 40s per barrel. And just to give you a sense, this project is very sensitive to oil prices. So at $65 a barrel Brent, the net present value, net to Rockhopper's interest, is around about $1 billion. If you move to $75 a barrel Brent, the NPV almost doubles. So hugely oil price sensitive. In terms of funding, which is the key outstanding work stream to sanction, we're making very good progress, as I say, on the contractor financing piece, which represents about $400 million. We're now into the detailed documentation phase. And on the senior debt, which is the heart of the financing strategy, we're talking to a range of commercial banks and export credit agencies with a view to securing around $800 million. We've had good indicative feedback from commercial banks, and good progress continues to be made, but frankly it is taking longer than we would like. It is, however, difficult for us to drive the timetable given the nature of project financing for an asset of this nature. In terms of the upside, I won't go into this in detail, but there is, broadly speaking, 200 million barrels of low-risk, near-field exploration potential, very easily tied into the main sea lion facilities, and therefore highly valuable barrels. This slide is really just talking about illustrating the further upside in the basin in Isabella Lane, which is around 30 kilometers to the south of Sea Lion, where we have drilled 2 wells very successfully, and we believe Isabella Lane has the potential to be as big, if not bigger, than Sea Lion. It does, however, require further appraisal, which we would look to do as part of the development drilling campaign on Sea Lion. I'm conscious of the time, but in terms of the greater Mediterranean, we have production of around 1,000 barrels a day, give or take, generates revenues of around $10 million per year. The revenues and operating cash flows cover not only the operating costs at the asset level, but also the corporate G&A. There is upside, which admittedly is primarily through an arbitration against the Italian government, where we are seeking damages for effective expropriation. That arbitration hearing is in February. We expect the result in the summer of next year, and potentially we are claiming several hundred millions of euros. We have a funder in place, so they're picking up all of the costs, and it is a no-win, no-fee type arrangement. So in the event we're unsuccessful, it's cost us nothing. In the event we're successful, we retain a significant proportion of the award. In terms of Egypt, our main producing asset is Abu Sinan, operated by Kuwait Energy. As I said before, this is not terribly exciting, not terribly material, but it does generate the production and the cash flow, which is intended to do to cover the corporate costs. In Egypt, we have a fairly active program. We're drilling 3 wells this year. The first well recently completed and brought onto production. Currently drilling the second well with encouraging results. I'll skip over that. In terms of financing, we have a strong balance sheet, 45 million of cash at the end of June. We have no debt. We have limited financial commitments. We've halved our G&A over the last 3-4 years in response to the oil price. In terms of outlook, all efforts are focused on progressing Sea Lion to sanction, where really it is all about securing the funding required to unlock the project and unlock the significant value within the project. In Egypt, we have an active drilling program in 2018. First well was successful, second well currently drilling, with results due in the next couple of weeks. We have the arbitration, which has the potential to be very significant. The hearing is in February, the outcome is expected in middle of 19, and unlike other arbitrations, maybe against India or Kazakhstan or Venezuela, enforceability is not an issue here. Finally, we do continue, as I said at the beginning, to actively screen for acquisition opportunities with a focus on production, with a view to adding more material cash flow and therefore allowing us to pursue other additional growth opportunities. Thank you very much.